As ARK Invest's founder, CEO, and chief investment officer, Cathie Wood is responsible for some of the biggest and most controversial funds on the planet. By the end of 2020, her Genomic Revolution fund almost tripled in price, making it the single best performing active ETF that year. At the same time, her main innovation fund took the crown for being the largest actively managed ETF on the market.
You're having one of the best years in the history of professional money management. What's it like?
But there's just one problem. Most of the companies that Cathie Wood picks are still not profitable. And right after their epic rise, Cathie Wood's funds have collapsed, losing around 60% of their value. They actually fell so far so fast that a separate fund came out with only one objective: betting against Cathie Wood.
I don't know how else to say it. They're not shorting innovation, they're shorting you.
If you tally up the combined damage, ARK Invest's funds lost a total of over $35 billion in assets under management. And that really begs the question, why would anyone ever invest with Cathie Wood? To answer that, we need to answer a different question first. What are the actual goals of ARK Invest's funds? My name is Alex, and I'll answer both of these questions by taking a look at the science behind these stocks. So, what are the actual goals of Cathie Wood's funds? Let's start with the big picture. ARK Invest has 9 funds and they all have roughly the same broad goal, which is to provide a way to invest in specific groups of innovations or different advanced technology themes. For example, ARK Invest established the Total 3D Printing Index, and they have a 3D printing ETF that tracks it. 3 of their 9 funds are index funds like this, and they're passively managed and rebalanced quarterly. We're actually interested in the other 6 funds because Cathie Wood actively manages those, meaning she trades the stocks inside them about every market day, not just once a quarter. These actively managed funds include the one themed around gene sequencing, gene editing, and other advances in applied biology. That fund's ticker is ARKG, and it was the best performing ETF in 2020. And of course, this also includes ARKK, which is ARK Invest's flagship innovation fund, which was the biggest ETF in 2020 by assets under management. That one is filled with ARK Invest's highest conviction investments from any area of innovation that they follow, like genomics, autonomy and robotics, artificial intelligence, financial innovations, and even space exploration. That means the holdings inside ARK Invest's funds actually overlap by quite a bit. This is pretty different from how other investment firms tend to break out the market. Normally, every stock falls into one of 11 sectors like information technology, consumer discretionary, energy, and so on. The goal of breaking stocks into these sectors is to make it easy to compare companies with similar business models. So here's a pop quiz. Which sector do you think Tesla belongs to? Energy? Information technology? Consumer discretionary? The answer is actually consumer discretionary, along with similar businesses like Nike, McDonald's, Amazon, and Disney, all of which are also in this consumer discretionary sector. Yes, really. According to ARK Invest, traditional market sectors do a bad job of categorizing modern companies like Tesla, who build products and services that have a wide variety of use cases in a wide variety of markets.
These platforms cut across sectors, they cut across geographies, they cut across markets.
Here's another example. Amazon Web Services powers roughly 1/3 of the internet today. Should Amazon really be considered only a consumer discretionary company? Let me know in the comments below how you would categorize the different companies you follow if you wanted to compare them. This is actually where the science behind the stocks comes in. In ARK Invest's opinion, you tend to be able to make better apples-to-apples comparisons between companies when you group them by their foundational technologies like artificial intelligence, robotics, or gene editing. Another thing to think about is that modern companies tend not to focus on only one technology. For example, Tesla innovates in artificial intelligence, robotics, and energy storage. So while traditional stock market analysts put Tesla in only one sector, consumer discretionary, ARK Invest is putting them in 3 very different themes: artificial intelligence, automation, and energy storage. Before I became a full-time investor, I worked as a rocket scientist at MIT's Government Research Center, and guess what? MIT also breaks its research groups out by foundational technologies. So there's a group that helps solve radar problems for a wide variety of applications, and there's another group that works on 3D printing. The idea is when you become an expert in a technology, you can solve problems for a wide variety of use cases across a wide variety of industries that use that technology. So from my 8 years at MIT, I really believe that ARK Invest is right about how to categorize these companies. In fact, the entire purpose of this channel is understanding these technology platforms and what their progress could mean for investors. ARK Invest actually has another core philosophy that investors really should be aware of. You can find this right on their website. Quote, "The world is changing rapidly. While traditional investors seek safety in benchmarks and passive strategies, ARK believes this behavior is counterproductive. Innovation is causing disruption, and the risks associated with the traditional world order are rising. We strive to invest at the pace of innovation." I believe that little blurb is responsible for everything that investors love and hate about ARK Invest. One side effect of only investing in innovation is that bleeding edge technology companies are often young, still unprofitable, and hard for non-technical people to understand. That makes them some of the most volatile stocks on the market today. Also, as a result, they're very long-term investments because it takes time for them to penetrate their target markets and disrupt the existing established players. That's why these companies are often called growth companies. They're early enough in their life cycle that they're still growing a lot each year as they capture new business. The thing is, all long-term investments always get hit the hardest when inflation goes up and the Federal Reserve starts raising interest rates, like they're doing right now and will be for the next few years. When that happens, growth stocks get hit the hardest. It doesn't matter if they're in healthcare or robotics or the blockchain because money gets more expensive to borrow for all of them. So if Cathie Wood's goal was to make investors as much money as possible, concentrating solely into these kinds of growth companies would have been a $35 billion mistake since her combined funds dropped from just under $60 billion in assets under management to under 25. But now you understand that that's not really the goal of these funds. ARK Invest's actual goal is to provide funds that cover these different advanced technology themes and that can react to major advancements in technology by being actively managed. So even if you believe strongly in the long-term performance of these funds, this is why it's so important to diversify into assets that can generate solid returns but don't correlate with growth stocks. I actually spent a lot of time digging into this, and the partner for today's video is a great way to do just that. Masterworks.io is the only platform that lets you invest in physical, multi-million-dollar paintings without breaking the bank. Contemporary art pieces have almost tripled the S&P 500's total return from 1995 to 2020. That's way more than you thought, right? Another thing I really like about Masterworks is that they're focused on the investments, not just the art. Their team of analysts use proprietary data to identify artists whose work would produce the best risk-adjusted returns. That's important here. Then they acquire paintings by these artists, file the artwork with the SEC, and securitize it. Then regular investors like you and me can go to Masterworks.io and buy shares of multi-million-dollar art just like we would buy stocks. Just a few weeks ago, they sold an Albert Olin painting, returning almost 34% to investors after all costs and fees, and that painting was initially offered just 1 year before. Pretty good, right? So I reached out to Masterworks and they're giving you VIP access to their latest offerings, including their newly acquired Picasso painting. So if you want to skip their waitlist, I'll leave a link to that exclusive offer for you in the description below. That quote on ARK Invest's website actually reveals another interesting thing to consider. While traditional investors seek safety in benchmarks and passive strategies, ARK Invest believes that this behavior is counterproductive. That's a big statement because passive management makes up over 40% of all funds on the market today, which is about $10 trillion in assets under management. Remember, passive management is where a fund follows certain rules and only rebalances quarterly. You've probably heard of SPY, which is just one fund that tracks the S&P 500 index. SPY alone has $450 billion in assets under management. QQQ is just one fund that tracks the NASDAQ index, which is another $200 billion in assets under management. These funds are the market. That doesn't mean that ARK Invest wants their funds to go up when the market goes down. It means that they want their funds to go up and down regardless of what the rest of the market is doing. That's one reason that they don't usually hold stocks like Facebook, Apple, Amazon, Microsoft, Google, Nvidia, and other truly great companies, since those stocks are at the top of these indexes today. So, even if you believe strongly in disruptive tech companies providing great returns in the long run, another great way to diversify from ARK Invest is to hold the kinds of tech companies that sit at the top of these passive indexes. There are two great reasons to do this. First, these companies aren't worried about interest rates rising and money becoming more expensive to borrow. They have a ton of free cash flow coming in because they're well established and profitable, unlike most younger companies. That's one reason their share prices dropped a lot less than the stocks inside Cathie Wood's funds. Second, even though I'm a huge ARK Invest fan, I'll be the first to admit that companies like Amazon, Google, Microsoft, and Nvidia aren't going to be that easy to disrupt because all four of them constantly push the limits in the same technologies that ARK Invest thinks are so disruptive. As of 2020, Amazon has over 200,000 robots across its warehouses. Google's AlphaFold AI program recently made huge advancements in protein folding, which has a lot of applications in genomics. So investing in these companies lets you stay invested in the innovations you believe in, like artificial intelligence or robotics or advanced healthcare, but lower the overall volatility of your portfolio compared to ARK Invest's funds. And if you don't want to keep up with all the science behind these stocks, you can still find a great fund that holds them all. For example, check out Vanguard's Mega Cap Growth ETF, ticker symbol MGK. That's a passively managed index fund with stocks like Apple, Microsoft, Google, Amazon, Tesla, Nvidia, and Facebook right at the top. Alright, now that we understand that Cathie Wood's funds are really about giving investors exposure to different innovation themes, what some of their weaknesses are, and some ways to lower our own risks while holding them, we can answer the big question. Why would anyone ever invest in Cathie Wood's funds at all? The answer is because they're actually pretty great at understanding the science behind the stocks and valuing that science pretty far out into the future. For example, they correctly valued Tesla at over $4,000 per share pre-split, way back when other big stock market players were still saying that Tesla is about to go bankrupt. Another big reason is that they've actually almost never missed their 5-year target return. Cathie Wood always says that her funds expect an annual rate of return of about 15%, which is about a doubling in value every 5 years. That's the number to focus on. Even at its lowest point in this most recent crash, ARKK was up about 140% from its price 5 years ago. In fact, one of the only times that Cathie Wood's 5-year returns didn't hit triple digits was in the depths of the pandemic crash of March of 2020, which really only lasted a few months. And she's investing in a way that doesn't move with the rest of the market, so you're actually lowering your overall long-term risk, but not your overall long-term potential gains. The trade-off for this is the short-term pain from high volatility, and if that's not something you can hold through, that's totally fine. Don't let anyone tell you that that somehow makes you a bad investor. Want to know how I deal with these crazy crashes myself? Check out this episode next. And if you feel I've earned it, hit those like and subscribe buttons to let me know that you enjoyed the science behind these stocks. Either way, thanks for watching, and until next time, this is ticker symbol U. My name is Alex, reminding you that the best investment you can make is in you.